Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, February 13, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And the market is doing, for the most part, exactly what we discussed that it should and most likely would do following the bottom that was made last Friday. Last Friday, the market came in and pierced through slightly and had a rocket ride off of the 200-period moving average. It put in a long tail candle, and under normal market conditions, that long tail candle is a signal of a trend change. Whether it be short or long term, it's still a signal of a trend change, and so far, that's what we've seen. So we had a relatively calm day in comparison to what we've seen over the last several market sessions for the last couple of weeks. The Spider was up 1/3%, 83 cents, and the range today was relatively narrow. It was the narrowest ranging day that we've seen in about 7 or 8 trading sessions. So the market is likely, and we discussed this last night, the market is likely headed to test the high of the last breakdown candle right here. And that's going to be an important level for the market to get through, or the Spider to get through. That level comes in at 268.17. Will it get through there on the first hit? Most likely not. It certainly could. Anything could happen in the markets. We always have to be prepared for and expect the unexpected. But under normal market conditions, the probabilities say that when the market, and if the market, gets up to that 268.17 level, it will likely be, at least from an intraday perspective, rejected on the first run higher up at that level. That's just the way the markets work under normal conditions. There is a way that the market can get through that area with relative ease, and that would be if in fact we had a large gap higher and the Spider or the S&P 500 jumped over that level. It's certainly possible. It's obviously happened before. That's the easiest way for the market to get through an important level. Will that happen? We have no idea. Is it likely to happen? If there's a news event that jumps the market higher with some unknown black swan event, of course it could happen. It's just unlikely to get through there on the first hit. Generally speaking, once we get up to that level, which is slightly, it's about 20 S&P handles away from where we are now, 20 S&P points. Once we get there, that level should act as a resistance point to the market. Now, what if we did get through that area? What's the next likely resistance point or resistance level for the Spider? Well, that really comes in at the 50-period moving average. Today comes in at 271.52. That would be the next major area of resistance on the upside. You'll have some resistance at this candle high here, and then the 50-period moving average comes in right above that. So the market will just stair-step its way higher and stair-step its way lower under normal market conditions. Of course, we had a hard sell, and the market was cutting through certain what normally would be support levels. It was cutting through them like a hot knife through butter on the way down. But on the way back up, unless the market is taking a rocket ride higher, it's relatively tame right now, speaking from experience from today. And therefore, if we trade under normal market conditions, you're going to see normal garden variety resistance levels on the way back up. I would think this general area right in here is going to be very, very difficult for the market to just walk right through, at least on the first shot. I'm not saying we can't go higher from here, and I'm not saying we can't get higher than where this circle represents. What I'm saying is, if we get up to this level, if we're fortunate enough, if the bulls are fortunate enough to get up to this level, that's going to be very formidable resistance for the market. The bigger picture is, I still contend that we're not necessarily finished on the downside. I think there's a high probability that we have another leg down. I'll start disbelieving in another leg down and believing in a resumption of the up move if, in fact, we close above the 20-period moving average, at least for a couple of days. That's the red sloping trend line. If that happens, I will begin to believe more in the upside and less in another leg down. Until and unless that happens, I still am of the belief that there is one more leg down in this market on this particular corrective move. Just to be clear, we haven't really damaged the long-term uptrend to this market. Nothing's happened to the long-term uptrend that still exists. However, that doesn't mean we can't have and shouldn't have corrections along the way. I just believe that this correction was too short, and I think there's one more leg down, which will be designed to make the bulls in this market believe that the long-term rally has ended and that we're beginning a long-term correction. That's at the point in which the market will find bottom and we will resume the uptrend in this market. The market works and operates based on emotions of investors and traders. So for example, we go up and up and up each and every day for many, many months, many years for that matter. Not up every day, but we had one heck of a bull run in this market. We got to the point where nobody believed that the market could ever go down. Anytime there was the slightest dip, it was a buy the dip mentality and the market finished up for the day. That happened time and time again. Finally, we have an semblance of a correction, which in the big scheme of things is normal garden variety market behavior. Markets have corrections. That's the way it works. But in my opinion, in order to resume the uptrend, if it's going to resume at all, we have to get some of the bulls into the bearish camp and have them believe that the bull run is over, at which time they'll flip the switch and resume the uptrend. That's what I believe is going to happen. That down leg, if there is another down leg, it still may be a week or two away, but I think this correction was too short in time. I think time is more important than price. So we'll just take it one day at a time and one price level at a time. If we get above this red candle high, we'll look to the 50-period moving average. If we get above the 50-period moving average, we'll go to the next level. The IWM, or the Russell 2000 index, my favorite market-leading indicator, both in the up and the downward direction, you can see here that it was pretty much on par today in terms of a percentage move with the S&P 500. So it was up about 1/3%. Now, I could build a case pretty easily that we're putting in a bearish pattern. So we have this down move, and the spiders are no different. So we have this down move, and we're putting in what I like to call a bearish wedge pattern. Until and unless we close any day above this breakdown candle high, then this is still susceptible to another down move. I'm not saying we will or won't close above this level, but until and unless we do, this market, as well as the spiders, are susceptible to another leg lower. There's also a divergence that I want to point out that exists between the IWM and the S&P 500 or the spider. So the divergence is this. There's actually a couple of them, but this is the one I want to point out. Look where we are as it relates to the 100-period moving average. The 100-period moving average is the purple sloping trend line. We're beneath and have been beneath for several days the 100-period moving average. We're above the 200-period moving average, but we're sandwiched in between the two. The question is, who's going to win the battle, the bulls or the bears? In order for the bulls to win the battle, obviously we have to get back above, on a daily chart closing basis, the 100-period moving average. If the bears win out, we're going to get below the 200-period moving average and trade lower. That looks very similar in terms of the 200-period as the spider. However, when we go back to the spider, what you can see here is we're maintaining the level above its 100-period moving average. So the spider is somewhat of a bullish divergence from the IWM, but I contend that the IWM is the market-leading indicator that will generally win out and project what's coming in the long run. And right now, the IWM, in my mind, and the way I view the charts, is the weaker index. And until and unless we can get back above the 100-period moving average, I think things are a little shaky, and I'm still looking for another leg down. Doesn't have to happen tomorrow, and it doesn't have to happen on Thursday or Friday. I just think there's another leg down in this market after we work off some of the severely oversold condition. Just when people think that the selling is over and that the bull run is resuming trend, that's when you have to be looking for them to pull the rug out one more time. Doesn't have to happen. I just think it's going to happen. I'm happy to be proven wrong, and I know the levels that each market has to trade above in order for me to take that particular outlook off the table. As it stands right now, I'm still looking for another leg lower. Much of the same story in the transports. The transports are above their 100-day moving average as they are in the spider, and the transports are getting a lift with all the other markets working off the oversold condition, but we have that same phenomenon. We have that breakdown candle, and we have to get above this candle and close above this candle on a daily chart in order for me to begin to feel more comfortable that there's much more upside and less likely more downside in this market. Very similar story to the other two markets. They look very close to the same. Rising tide lifts all boats, and right now that's what we're seeing. We're seeing the markets just lift higher and probably will last at least for another day. Switching gears, looking over at the gold market. Here's the gold futures contract. Look where we went today. We're at 1332 as I make this video. We hit a high today of 1333.50. 1333 even was my important level, so we're right at the important level. It will be interesting to see over the next day or so if we're able to close above 1333 and of course 1338. What you'll notice is the 20-period moving average comes in right around the same level as that 1338 number. So it's not going to be a cakewalk. If gold tries to get higher, it's not going to be a cakewalk that it just runs right through this area. I think it's formidable resistance. We'll find out over the next day or so. But this could be the makings of an ABC pattern, and sometimes we show it in the upward direction and sometimes in the downward direction. Here's one in the downward direction. So we have the first leg down, that's the A leg. Here's your B leg, wherever it decides to end, if it ends at all. And then your C leg would be another leg lower. That's the pattern I see as potentially developing. There are quite a few hurdles that we have to get above in order for this market to continue in the upward direction and resume the uptrend. The first level and most important level is 1338, which is also coinciding with the 20-period moving average. If we begin closing days above 1338, I'll begin to think that it's more likely a resumption of the uptrend than an ABC corrective pattern that still has a C leg outstanding. Crude oil, we're still hovering at these lower levels, certainly above the 58.25. That was the important level. We came in and tested that the other day, and we bounced off that level. We had a nice rally yesterday, but a failure. And today, we're stuck in the mud down here at 58.95. We went down and we didn't quite test the 58.25. We came as low as 58.38, I believe is the low. Let me double check. The low today was 58.39, and we're trading right now 58.95. But what I see potentially happening, right, potentially, is a bearish pattern developing. If that's the case, and a bearish pattern develops, you will have had a down move, a bearish pattern or bearish wedge pattern. That likely means another down move coming. However, if we can get off the mat relatively quickly, we can get some upside going, then that will have been or could have been a successful test of the former breakout area, and that's what we're talking about. Markets like to come back and test former breakout and former breakdown areas. This area right here was a former breakout area. The market broke up. We came back down to test it, and we'll see what happens. Give it another few days. If this is a successful test of the former breakout area, then we have another leg higher in crude oil. And you can see that more clearly as evidence from a longer-term chart. If I go over to the weekly chart, it's a pretty big down candle from last week, but all we really did was come back to test a former breakout area. You had an area of consolidation for a few weeks here. The market broke out. We came back in to test that area, happened to coincide with the 50-week moving average. At the time, at some point last week, I mentioned if the market comes down to test 58.25, that's a lay down trade. It proved to be true. It was a lay down trade on the long side. Now we have to hold this area, and if the market does, then we can resume the uptrend. Now we've had quite a retreat from the first attempt at the 200-period moving average. If the market resumes the uptrend, this 200 period moving average is going to be much less important than it would otherwise be, specifically if it was coming into that level on the first hit. If we resume the uptrend, that 200 is not going to be much resistance at all, in my opinion, but I think the real resistance point is the red trend line you see on the screen. The exact number, as far as my math is concerned, comes in at $73.78. Maybe it's 74, maybe it's 74 and a quarter, but something in this neighborhood is where I believe crude oil will come into a lot of resistance. That's a long way off. First, we have to resume the uptrend. We're a long way off from the 70s right now. Listen, those of you that have been with me for a while will remember discussing this bullish pattern, saying as long as this low holds, that we're going to have another leg higher in crude oil, and this was a bullish pattern that will play out to the upside, and we're about $20 in the price of crude oil removed from that point in time. That was only around last summer and into last fall. So that's been quite a run for crude oil. It's normal and common market behavior for us to work off some of the overbought condition that developed of recent, but now it's time for crude to make a stand and hold this 20-week moving average. And with that, folks, it's everything that I wanted to and intended to discuss tonight, so I'm going to give it a wrap. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.